Dividend stocks are believed to be good sources of generating income with less effort. Although dividend stocks may not provide you the advantage of substantial capital appreciation over a long time, they offer the advantage of consistent and continuously increasing income stream over a period of time. This characteristic in itself makes it a preferred option for those that are approaching retirement and risk-averse investors. This kind of individuals typically prioritize stability and consistent cash flow over time. In this video, I'll be talking about Canadian dividend stocks you need to buy and hold in 2023 if you're looking to make decent passive income, say $150 and above per month. Hi everyone, my name is Ebuka and this is the Finance Wiz channel. In this channel, I typically talk about everything personal finance, from income generation to savings, investments, and debt management. If this is your first time on this channel, I want to say welcome to this channel, and I assure you you're going to be getting a lot of values from this channel. As such, I want to encourage you to like, share, and subscribe to this channel because there will be lots of gems for yourself and as well as your friends. If you have been on this channel before, I assure you also that you will not be disappointed in terms of the quality I will be giving you in each of my videos. Now, most importantly, I want to encourage you to please click on the notification bell so that you'll be notified whenever I drop any video so you don't miss any of them subsequently. Now, back to the Canadian dividend stocks. It's actually very important for you to know that the stocks with the highest dividend yields are not necessarily the best stocks you should be buying. It's actually not very safe to focus majorly or solely on dividend yield alone. This is because a persistent rise in dividend yield sometimes could be indicators that the business is actually failing or the share price is likely going to drop in the future. Now, based on this understanding, I've selected a list of 5 Canadian stocks you should consider buying and holding today. I've carefully selected them based on certain criteria which I believe you should consider whenever you want to buy any dividend stock. So number 1 is based on dividend streak, which reflects how long the dividend has been paid. Number 2 is the dividend growth rate, which reflects the annual growth of all dividends paid on a year-by-year basis. So number 3 is dividend payout ratio, which reflects the percentage of earnings that a business has made in a particular year and how much of it is willing to give out as or pay out as dividend. So something you need to know is that if the payout is actually low, it means that there is more room for investment of earnings in capital projects that can result in even additional cash flow. The next is the business valuation, which simply looks at the share price and the number of shares that the business has. As part of the business valuation, you want to consider factors like the growth in the share price, as well as the cash flow and the returns on equity you will be expecting. So my first stock is Enbridge with the ticker symbol ENB. So Enbridge is a multinational pipeline and energy company with its headquarters in Calgary, Alberta, Canada. So Enbridge has the longest pipeline system in North America and the largest oil export pipeline in the world. So Enbridge operates through 5 major segments. This includes liquid pipelines, gas transmission and midstream, gas distribution and storage, renewable power generation, and energy services. Now let me show you some stats about Enbridge on Google Finance. Now Enbridge trades at $48.38 and has grown in 5 years by 3.24%. As you can see my mouse hovering over. Now you can see that. So this stock trades on the Toronto Stock Exchange and it has a market capitalization of 98 billion Canadian dollars. It has a PE ratio of 41.03 and a dividend yield of 7.34%. That's to say if you invest $1,000, you should be getting about $73 in a year. Now if you scroll all the way down, you can actually see financials of the company. So let's see what the financials of the business is saying. Now it's important for you to review the financial statement of the business for you to determine if the stock is something that works for you or not. As you can see, on an annual basis, this business has shown some sort of consistency, right? Now if you look at 2018, where my mouse is hovering over, he had a revenue of $46.38 billion and a net income of $2.88 billion. And as at 2022, it had a $53.31 billion and a net income of $3 billion, which shows an increase in revenue over time. Now, as you can see from here, it has a year-over-year change of 13.25%. This gives me some sort of comfort around the stability of the business. Now, you can also go into their assets in the balance sheet, look through the cash and short-term investments, and the total asset the business has. Now you can see from my mouse hovering that the total asset was 166.91 billion, as well as liability of 93 billion and 179, which shows a significant growth from 2018 to 2022. So I also love this stock because it has a 5-year dividend growth rate of about 7.3%. And it also has a dividend increase streak of about 27 years, which provides comfort around the consistency in dividend payment over time. So the second stock I'll be talking about is Telos, with a ticker symbol of T. Now Telos is a telecommunications company based in Vancouver, BC. So this business has more than 10 million subscribers and is one of the 3 biggest telecommunication businesses in Canada. Now, I love this business because not just has it operated within the telecommunications sector like its counterparts Rogers and BCE, it has also diversified into other areas such as the healthcare sector. Now, let's go to Google Finance to see what it tells us about the performance of this stock. So, Telos Corporation trades in the Toronto Stock Exchange at the market price of $25.76. It has a market capitalization of 36 billion Canadian dollars, a price-earning ratio of 25.09, and a dividend yield of 5.65%. That's to say, if you had $1,000 invested in this stock at the current share price, you should be getting about $56 in a year. Now let's head over to the financial statement of this business so you can determine how well this business has operated for a while. Now I'm using a 5-year benchmark period to assess this, and as you can see from my screen in the income statement, on an annual basis there has been a growth from $14 billion in 2018 up to $18.29 billion in 2022 in terms of the revenue, which shows continuous growth and gives me some level of comfort around investing in this business. Now, if you take a step down, you can also see that there's a year-on-year change of 8.64% to the 18.29 billion it currently has as revenue in 2022. If you scroll down to the balance sheet, you can also see that it has a $1 billion cash and short-term investments and a total asset base of $54 billion. Now, the total asset has grown from 33.06 billion in 2018 to about 54.05 billion in 2022. That's to say it has almost doubled its asset base since 2018, or within 5 years. So it's fair to say that a company of this size with this level of asset base can give you some comfort around its stability and continuous growth into the future. Now, in terms of its dividend growth rate over a 5-year period, it has experienced a 6.6% dividend growth over the last 5 years. It has also consistently increased its dividend payouts on an annual basis over 19 years. This gives you some level of comfort around investing in this dividend, and it provides some assurance that there is a likelihood that it will continue to pay dividend into the long term. So my third stock is Fortis. It goes with the ticker symbol FTS. It operates a portfolio of 10 utility transmission and distribution assets, including electricity generation assets in the Caribbean. Its operation spans across Canada and the United States with a worth of over $60 billion. Now, if you're wondering about the security of this business, just so you know, Fortis services are majorly based on regulated assets, which accounts for 90% of its operations. This in itself provides some sort of guarantee in terms of the cash flow predictability, and of course, as investors, it enhances our trust and confidence in the stock. So the other thing you need to know is that Fortis has a lot of plans around strategic expansion, including acquisitions and investments in different utility projects across the utility sector. The expectation is that this would drive dividend growth to about 10% within the next 3 to 5 years. Now let's head over to Google Finance to see what the performance of this stock has been over the last 5 years. So FTS trades on the Toronto Stock Exchange at the price of $55.98. It has a PE ratio of 19.00 and a dividend yield of 4.04%. That's $40 for $1,000 invested in this stock at the current share price. Now, if you look at the stock price changes in the last 5 years, you can see that as at 2018, the price was 42.58 and currently it sits at 55.98, which reflects a 31.47% increase in this stock price in the last 5 years. Now, this stock has a 5-year dividend growth rate of 6.1% and a dividend increase streak of 49 years. In summary, although Fortis may offer a relatively lower dividend yield, Its long-term dividend growth and strategic expansionary activities positions it as a reliable option for investors that are seeking steady and consistent dividend growth and income over a period of time. So my fourth stock is Royal Bank of Canada with the ticker symbol RY. So Royal Bank of Canada is one of the top 3 banks in Canada. RBC serves different clients including personal, business, public sector, and institutional clients in Canada, as well as the United States. So more than 60% of RBC's earnings come from personal and commercial banking, as well as from capital markets. Now, I love RBC because it has been paying dividend for more than 150 years, since about 1870. Now, Royal Bank of Canada stock, which trades at the ticker symbol of RI, trades at $125.52 in the Toronto Stock Exchange. It has a market capitalization of 174 billion Canadian dollars, a PE ratio of 12.4, as well as a dividend yield of 4.3%. That's you're likely going to get $43 for a $1,000 investment in this stock. Now let's head over to the financials to see how well it has performed in the last 5 years. Now in 2018, you can see it has made a revenue of 41.27 billion and currently has a revenue base of 48.50 billion in 2022, which shows some sort of growth. Now, if you go down to the assets, the balance sheet, you can see that the asset base has also grown from 1.3 trillion in 2018 to about 1.92 trillion in 2022. Now, if you're still concerned about the stability of this business, you can clearly see that it has a cash and short-term investment of 743 billion, which shows a year-on-year increase of 8.54%. The returns on asset of this business also sitting at a comfortable 0.87%. Now, this should give you a lot of comfort around investing in this stock. So my fifth stock is Canadian National Railway. It goes with the ticker symbol CNR. So CNR is a Canadian Class 1 freight railway and is Canada's largest railway in terms of both the revenue and the physical size of its overall network. So it has a network of over 20,000 miles across Canada and Mid-America, and it connects the Atlantic, the Pacific, and the Gulf of Mexico. Now, I also love CNR because it's a highly diversified business, because no business unit accounts for more than 25% of its revenue base. So CNR trades in the Toronto Stock Exchange at the price of $153.52 currently. Now, this reflects a growth of $40 in its share price since 2018, which is also equivalent to 35.95%. So this stock has a market capitalization of 103 billion Canadian dollars, a PE ratio of 19.28, and a dividend yield of 2.06%. Now let's head over to the financials to see what it's telling us about its performance. Now if you look at the 5-year income statement, you can see that it grew its revenue from $14.32 billion in 2018 to $17.11 billion in 2022. This gives some level of comfort around profitability of the business over time. So another thing is that the dividend growth rate over a 5-year period sits at 12.2%, and it has consistently increased its dividend payouts over 27 years. So I thought to give you guys a bonus stock just for the take home. Now this stock I'm going to be talking about is called Manulife, and Manulife trades on the Toronto Stock Exchange with the ticker symbol MFC. So Manulife is a Canadian multinational company that provides insurance services as well as overall financial services, and it has its headquarters in Toronto, Ontario, Canada. MFC operates in both Canada and Asia using its name Manulife, and in the United States through John Hancock Financial Division. Manulife is regarded as one of the largest insurance companies in Canada. So let's take a look at Google Finance to see the performance of this stock. So Manulife Financial Corp trades at $24.6, which is a 3.89% increase since 2018. Now, it has a market capitalization of 45.25 billion Canadian dollars, a PE ratio of 8.5, and a dividend yield of 5.93%. It also has a 5-year dividend growth rate of 9.16% and has consistently increased its dividend over 27 years. Now, just to conclude, please remember that dividend payments are not guaranteed. However, you want to rely on the historical streak of payments in the past to determine the likelihood that the dividends will be paid over the years. And like I said earlier, you need to analyze other factors in addition to the dividend yield to determine if a stock is worth investing in. In my subsequent video on this dividend series, I'll be showing you how to analyze the financial statement of different companies to determine if you need to invest in their stock or not. So if you don't want to miss them, please like, subscribe, and share this with a friend, and most importantly, click on the bell icon so you are notified when the video drops. Thank you and have a good one.